in 2026, I am investing and trading differently, not because markets changed, but because I did. After 5 years of trading primarily in the US and Canadian stock market, I've realized something uncomfortable, that more trades didn't make my return better. In fact, I ended up paying way much money in terms of fees. So in this video, I will show you why I am going to be trading less in this year and how I research wonderful businesses that I otherwise want to own, and how I use option strategies such as cash secured puts for cash flow, and also to potentially buy these wonderful businesses for a discounted price relative to the current price, and how I control risk. And this is the exact framework that I am using in 2026. Now, quick disclaimer, this is educational content, not personal financial advice. I'm sharing my own experience, but also do your own research before you invest or trade your own money. Or if you want to learn more, I coach people and have limited sports. I can do a one-on-one coaching so that we can talk more about your specific risk tolerance, your goals, because there are quite a lot of parameters that come in when I consider investing, right? The point of departure for me is, let me share some of the key things that I've learned. I started trading and investing in 2012. Those people who have been following me on this journey, they know that I've been talking about this. I'm an economist by training, and I started trading and investing, in fact, in an accidental way, because it was at the height of the COVID pandemic. And I noticed that the stock market was actually a thriving business. Some people were losing money for sure, but there were also opportunities. So I started trading and investing, but over the past 5 years, I made quite a lot of mistakes, but fortunately, I've been able to make more money than I've lost. So over the years, I've refined my strategies, learned my ways, and that's why I'm so passionate about sharing this information of what I'm actually learning in real time. So the key things that I have learned is that over these past 5 years, I've noticed something about my own behavior, because the stock market, the market doesn't really care about your emotions, how you feel. It's the market. Mr. Market, as Ben Graham, who wrote a famous book, The Intelligent Investor, mentioned. Sometimes a lot of people, they approach the market thinking that, oh, I'm going to make money quickly and stuff like that, and then they lose money. There are a lot of players in the market who can actually drive the prices in any direction. You're looking at big hedge funds, big banks, right? And other, investors, especially if they operate in a concerted or as a consortium, they can potentially drive the prices up, because we are talking about demand and supply driving the price of those shares. So what I noticed is that my own behavior was that I was reacting more than I am supposed to. For example, there's a news headline and the price of the stocks that I'm following, they're actually dropping. I'm like panic, saying, oh, this stock is going to probably continue going down. So I noticed that if I am a trader, retail investor, buying and holding stocks, I should be excited if the stocks drop. But not every stock is a good stock to own, or not every good stock is always at a good price to buy. Some good stocks, they might be overvalued, because usually stocks, they tend to go to revert to the mean, what we call mean reversion. If it's overvalued, investors might say, okay, this is overvalued, so maybe let's take some profit. And if they act in consortium and sell at the same time, they may potentially push the price to go down, maybe to what we call equilibrium, or the average price, or the fair value. So once the stock is at that, there may still be some reasons, whether there is geopolitical news or something that may not be related directly to that individual publicly listed company. I want to be buying low and selling high if I'm just doing the traditional strategy. Now, the other strategy that I have been using is that I want to use options to manage risk. Cash secured puts in particular, for example, today Google is trading at $322.24 right now. But let's say I want to buy Google. Let's say if I consider the valuation to say, okay, right now it's undervalued, but I want to buy it even cheaper. It's at 322, let's say that. I can open a cash secured put by the percent by selling a cash secured put. That means I sell a put option with a strike price, let's say $300 when it's at 322, and I get paid, let's say $5. So for 100 shares, in that case, for one option contract, I will be paid $500. So what that means is that even if Google drops to 300, I still have my effective average price, buy price at $295. But if I take a delta, let's say delta, these are just parameters for the options. Believe you me, I used to think it's very complicated, and I didn't understand. There were a lot of parameters and some mathematical formulas behind what I would see on the brokerage firm on the price of the option share, what we call the option share. So I like to choose what is called the delta of about 0.2 to 0.3. It's not aggressive. If it's 0.2%, it means if it's 0.2, the delta, it means there is a 20% chance that the stock price might close that timeline. Let's say if it is 1 month or 1 week, it might close in the money. In other words, I will be assigned and be forced or required to buy those shares. So that's really the idea here, right? So I noticed that I don't have to be aggressive unless if the stock has really dropped significantly, and I believe that it, so I can be aggressive and go on the money. But usually I want to go below the current price. Or in fact, I just go for the delta between 0.2 and 0.3. This is from experience. When I've been doing this, I noticed that if I'm an option seller, as time goes by, time is working on my favor because options, they what we call decay, right? Theta. In other words, if you just buy an option contract, a naked option, in other words, you buy a core option 1 month out or a day out, it means each time, each second as it passes, it's likely to, lose value, right? But it can gain value if the trade goes in your favor. But research shows that 90% of traders who do naked options, they lose money. So only 10% actually expire profitable. So I want to be in a situation where my odds of making money is actually high. So I use cash secured puts as my strategy. And I don't try to predict the stock market to say, the stock is going to go to this direction on few businesses that I otherwise want to own. So that brings me to the second point, that I want to be focusing on researching companies, not trying to predict the market. Otherwise, the price of the stocks. So once I do my analysis, my research, I focus on the financials. I want to look at the profitable businesses. At least if it's something that just became profitable, it has to be profitable for the past 4 quarters. In other words, I don't want to be holding or trading businesses that are losing money, right? And I also want to look at the cash and cash equivalents. I want businesses that have a lot of a strong balance in their cash and cash equivalents. I ideally want 4 to 5 years, and I look at the trend. Not that guarantees what's going to happen in the future, but at least it shows me the history of the business to say, these managers, are they allocating capital appropriately, or are they, good stewards? Because when I'm investing, I'm buying shares for businesses, I'm investing my hard-earned money. So I want the, managers to be good stewards and to have a good return for value. So I look at that, and I also look at the management. And like I indicated earlier on, I want to get in when the stock is undervalued. Okay? So that is something that I have decided to be doing based on my experience. Now, waiting for undervaluation is not easy. So what I do is most of my time I'm researching this business. So I have a war list. So if I see a stock that is very interesting on CNBC or on Bloomberg TV, I like to look at to do my own analysis for the things that I was talking about, the financial, the price to earnings ratio. These are things that I've learned over time. And also even listening to people like Peter Lynch, who were successful fund managers for the Magellan Fund, and also Warren Buffett, who essentially retired on 31 December 2025. So these people, they manage billions and they learn things over the process. And what I've also noticed is that it's very important to have an emergent fund because prices go up and down so much that if the market drops, I'm not in a panic mode to say, oh, I should sell. I should be able to pay my basic living expenses. And because I use options, I sell options, I get them to actually, let's say if I want to fund my lifestyle. So that is something that I use to generate cash flow. If I'm not assigned, I keep the premium for the cash secured puts. If I get assigned, I write, I do what calls. In other words, let's say Google now I'm assigned at 300. I will sell a covered call, in other words, 1 month out, for example, and let's say 320 is my strike price. If it goes to 320, if I bought it at 300, remember I got 500. So my average, I would make, 2,500 in that case if the shares are called away at 320. I would get paid if I sell a covered call. Maybe I'll get $200. So I'm just giving you, some examples off the top of my head. So those are the strategies that I use. So that's what I'm going to be doing this year. I want to avoid naked options, like I said. And the framework that I shared with you guys is that I want to research businesses that I otherwise invest in, understand their fundamentals, like I shared, and wait for their valuation to make sense. So if I have a list of 50 companies, I've noticed that every day I might have opportunities to make trades. If not, that's okay. I'm not going to be making any trades in that regard. And I sell options. I use basically the Wilfred rate, sell cash secured puts if I'm assigned. I sell a covered call and I repeat, I generate cash flows in the process, which is something that is very, very essential. Now, I also want to highlight that it's important to understand the macro and geopolitics and just be aware and not reactive, because there's always news out there. And I want to be focusing on things that I think can potentially move the market or create opportunities, right? So I want to stay informed about the macro risks and geopolitics. It matters, right? You remember there was also the issue of tariffs, and also recently there was the capture of President Maduro by the US, the administration of President Trump. And this has an impact on the oil markets, because what happened is that oil stocks such as Chevron, ExxonMobil, and all these other oil stocks that are publicly listed, they went up on Monday, right after the capture over the weekend, last week. But now they've really gone down, because there's always this moving part. So I am not the kind of person who wants to think to myself, I can predict the market. No, I want to be aware of the risks and have a long-term mindset whilst holding wonderful businesses. So net trading helps me to lower fees, have clarity, and also consistent in my profitability. And my goal is not excitement in doing as many trades at a time. So my goal is durability. So thank you so much for hanging on this video up to this far. Make sure you subscribe so that this video can reach out to more people. And if you want to learn more about investing at a personal level, reach out to me via www.streetwiseeconomics. I coach people who want to learn about investing. And if you want investment or insights into how to construct a portfolio, I can walk you through how I do that using my own portfolio as a live example to you. So thank you so much. I will see you in the next one. Bye bye for now.